Welcome to FinScale, a podcast created by Solen Niederkorn, shedding light on innovation in finance, banking, and insurance.
Understanding climate risk with a business approach. Lukky Ahmed, CEO and co-founder of ClimateX.
When we talk about physical risk specifically and driving, what do they do with it and what do they want to do with it? Ultimately, it has to anchor to one of those things. And so what we've really managed to do, because of the way that we think about the problem statement, is go beyond the physical risk as being the focus of the conversation, which then pushes us up on the agenda in terms of the value that we bring to our customers, which it actually gets them to want to integrate us into their businesses.
The topic of climate risk is one that deeply concerns me, as it does many individuals I engage with. In the financial world, it's a subject that's perceived in vastly different ways depending on whom you speak to. I was keen to have this conversation because ClimateX's method strikes me as pragmatic, sensible, and attuned to business realities, a rarity in the climate risk analysis arena. Lukky, the CEO of ClimateX, is an intriguing figure with a profound grasp of his field. He has consistently impressed me since our initial meeting. Our discussion delves into their business methodology and the development of their Spectra model, an impressive and user-friendly tool. We explore how this UK-based startup achieves global reach in providing climate risk data by fusing scientific research with econometrics to produce comprehensive climate risk analytics. I assure you, the conversation is not just enlightening, but genuinely captivating. Enjoy the show. Hi, everyone. Hi, Lukky.
Hi, good to meet you.
Yeah, great to have you on the podcast. Really happy to dive into what you're building. It's been a while that we had planned the discussion, but then we finally found a date, which has been postponed again. But now we are here for recording. Thank you for your time. Can I ask you to introduce yourself to the listeners and tell a bit more about where you come from and your journey until now?
Yeah, sure thing. So firstly, thanks for having me. I've listened to a lot of the podcasts and they've been really good and interesting and insightful. So I am a fan of the show. Also, I guess just in terms of my background and introductions. So my name is Lukky. I am the co-founder and CEO of a company called ClimateX. Prior to founding this company, I spent a decade of my career working within the banking space, within risk specifically. And I did a lot of operational, transformational type work in the regulatory compliance space. And then I had a big business turnaround that I had to lead for HSBC in Turkey. And then I spent a couple of years in Hong Kong between 2015 and 17, actually, building the entire stress testing operating model across the whole APAC region for wholesale credit risk. So the part of the bank that lends to corporates, banks, FIs, there's some trade risk, market risk type work in there as well. So that was a bit of a baptism of fire, but taking a lot of these external macroeconomic shocks and applying it to the balance sheet and P&L of the bank and all the clients that we used to lend to, and understand what that meant from a financial point of view, and then turn that into business strategy, you turn that into pricing, into product, and so on. 2017, after nearly a decade at HSBC, I remember somebody told me that it's really, really cool that I've climbed the ladder and the tower of HSBC. The universe exists inside the hexagon. What a wonderful opportunity. And I think that became my jump off point to say, no, the universe does not belong inside a hexagon or in any particular logo. And I know that empowers a lot of people, but in my case, actually it did quite the opposite. And so in 2017, I left Hong Kong, left HSBC. I didn't have a plan, but I knew I wanted to work on something that I would build, and that's something I didn't know what it was. So I moved to London, went into consulting. So I didn't plan to do that. I was headhunted, supported one of the major European mortgage providers in stress testing initially. So the Bank of England stress test and understanding those shocks to the retail mortgage book, and then moving across into various other projects and programs. With finance, we're pulling their hair out because something was happening in the bank somewhere. It was hitting the P&L and they didn't understand it. And so my job was to sort of get my arms around that and really start to anticipate those risks and those challenges and the financial impacts and drive that through the business. So And that's where I met my co-founder, Camille, who was on the quant side, really building these models and throwing the numbers over to me to make sense of. So that's where things started. So even when I start to describe that, I guess, in terms of the type of work I've been involved in on the banking side, it's probably not very difficult to then see a connection between that world of taking these macroeconomic shocks and applying it to the balance sheet and P&L of the bank and our clients to looking at something more existential. Effectively, that's what happened was in 2020, we really, really wanted to understand because climate change as a problem was becoming more visible, I guess, just generally, people were becoming more aware of it. And my interest was in the fact that, well, hang on, physical climate risk, so something that's already happening and we're experiencing it, these wildfires, these floods and storms and so on. What happens if that directly affects a building that I own or I'm lending against? The value will change of the asset if it's flooded. So how do I think about that in terms of my loss exposure? What happens if I'm lending to a business and the business has a key distribution center that is completely flooded? Well, they can't get goods and services in and out. What does that mean? Right. And so how do they respond to that? What does that mean for the credit profile of that institution? And so all of that becomes really quite an existential risk that nobody was pricing. And I wanted data, really good quality, defensible data that I could use for the purposes of the similar types of work I was doing elsewhere, but within the banking sphere. And that's what we ended up saying. It doesn't exist in the market. We couldn't find data that we as practitioners would want to use because the governance and transparency wasn't there. And we went down this rabbit hole to understand the problem statement and wind the clock forward. We've now, I guess, established Climate X as one of the leading players in the physical risk market. So we're incredibly proud of the progress that we made so far.
And it's amazing. I saw you made a demo last time we discussed, and I was quite amazed. Question to you. You mentioned flooding, but there are many other kind of climate-related risks. Can you say a few words about that? And why did you decide to specifically focus on flooding?
Oh, actually, it's an interesting point. So I mentioned flooding as an example because it's what a lot of people are familiar with and it's more visible. But you're absolutely right. There are many other types of physical risks that we focus in on, and we do model internally. So we have a team of PhDs that translate these macro trends from the climate models, which tell you things like how much rainfall to expect, for example, in a particular scenario in a particular year. But what those models don't tell you is what happens when that water hits the ground, right? So we simulate that ourselves and turn that into real world impacts. We don't just look solely at flooding, though it's one of the biggest loss drivers globally in terms of the damages that people see, feel, and experience. There are other hazards. So first and foremost, there's different types of flooding. So flooding isn't just one type of thing. You can get river flooding where the banks overflow. If there's too much rainfall, then you have surface flooding where the drainage doesn't keep up. You've got coastal flooding and storm surges. So there's different ways that water can inundate parts of the land where they shouldn't be there, and that has effects. There's also, on our side, we do model uniquely, actually, geophysical hazards as well. So when I say geophysical hazards, we're talking about things that are involved with the displacement of the ground, right? Or the movement of the ground that we're stood on, for example. So subsidence is one of these silent and quite underestimated risks, which actually ends up costing a lot of money when it happens. It's just less exciting to look at because it happens slowly over time, where the ground is physically like swelling and shrinking. And so that then breaks the foundations of buildings. And actually, a couple of years ago in the UK, we had a 40 degrees day. And then what happened was that subsidence claims increased by 400% off the back of that.
Wow.
And so it had a huge impact to the insurers. And in France, it's a major issue. In mid-states in the US, it's a major issue. We also cover other things like storms and tropical cyclones, so, wind-related risks. Wildfire is one of those other things that people are interested in, but also from a productivity point of view, things like, extreme heat, right? If it gets really hot, then there's an impact, but there's also running cost impacts that comes with as well. So we do look at a broad range of the key hazards that exist in the countries where we serve our customers. So it is more holistic than
just floating. Yeah.
Yeah.
So you serve many kind of organizations, not only financial institutions. And how do currently organizations integrate these risks into their existing business strategy and their risk management frameworks? And do they? Naive question, but do they?
It's a really good question because actually the answer is not always yes for people that are exploring and writing about this topic in the annual reports, for example. So I guess there's if we take things a step back, we speak a lot around physical risk, right? So even now we're talking about floods and fires and that kind of thing. The reality is that our customers in financial services or asset managers, banks, whoever they are, in the end, they are looking to drive business impacts, right? And I think this is something that we really have started to understand around the way that we position even what we do. They want to either drive revenues, they want to be more competitive in the market, or they want to cut costs. That's what the CEO is always looking to do, right? And anything that doesn't do those things becomes automatically a nice to have. And so when we talk about physical risk specifically and driving, what do they do with it and what do they want to do with it? Ultimately, it has to anchor to one of those things. And so what we've really managed to do, because of the way that we think about the problem statement, is go beyond the physical risk as being the focus of the conversation, which then pushes us up on the agenda in terms of the value that we bring to our customers, which it actually gets them to want to integrate us into their businesses. And that's actually something that we have happen quite a lot, which is our customers leverage us, not for specifically regulatory reporting. And a lot of people feel that that's the obvious place to go is there's TCFD or IFRS SS2, there's the regulations coming in from the SEC, for example. Mm-hmm. So people think, well, for me as a business, Climate X, that should be great. People are forced to buy this type of data from someone somewhere in order to disclose their physical risks, right? So that's what they think of as the main use case. And it is true that there are buyers or customers of ours, or potential customers, I should say, that think of it as that way. I need to check this box and make the regulators happy so I don't get fined. That's it. Now, those types of buyers and those individuals in those companies, we fully empathize with the challenge of what they have, but that doesn't bring business value, right? What that does for anybody that's ever sold into a bank or an asset manager or any other type of corporate is it creates a cost center, which is I need to put money to this thing. So make it as little as possible, make the problem go away as quickly as possible. And if you can, get someone else to take the blame if something goes wrong later down the line. Mm-hmm. And so it's a race to the bottom because there's no value attributed to that work. It's just a disclosure. That's all it is. And so what we've done is we've said, well, actually, the reason why that happens is because whenever you deal with a bank or an asset manager, everybody else in the market, so peers of ours that are doing similar sounding types of work, they will say, here's your building or buildings, give me the addresses, I'm going to give you the physical risk rating, so a score of some sort that says there's a high risk or a low risk or a medium risk of a fire or a flood. And then what they'll do is that will turn into a nice, pretty looking picture that you can put a chart into your annual report. Mm-hmm. A lot of people, that's the minimum viable standard or the MVP of what they can get away with. And that's what they'll do in the customer side.
And it's just to be honest, it's just to check the box of the auditor.
Yeah, exactly. That's all it is. And it does, and you can get away with it. And so people do get away with it. And that's what they've been doing. Where things start to get more difficult is how do you take that physical risk? For example, if I'm a mortgage provider, so one of our customers is a major UK mortgage provider, so it's a bank. And what they do is they lend mortgages and therefore they know the addresses where those properties are, right? So we can run that assessment for them and give them risk rating. But they don't really care about the risk rating when it comes to the real business side. What they need to understand is if this building is exposed to flooding, how much damage is that going to cause? How does that affect the value of the asset and what I've lent against it in terms of my exposure, mm-hmm. right? So they're trying to work this bit out, this component. To do that, you have to turn this physical risk into a dollar impact, right? Or a euro or a pound impact. It has to be translated to a financial metric. Now, if I've got 1 million properties or 300,000 properties in my portfolio, how do I do that? Because I only have the address. And the way that you can do it is to recognize the vulnerability of the asset. And so that becomes very difficult because I've got so many of these properties and I don't have that information stored anywhere. So how do I connect the dots between the physical risk and the fire or the flood and the building itself and its characteristics and how vulnerable it will be? So for example, if I have two buildings, one's made of timber and it's a super dry day and it's just wood, and another one is made of concrete and a fire comes rolling through, well, maybe the one made of timber will be more damaged than the one made of concrete, right? That one will burn around and the other one will still be standing. It'll be charred, but it'll be standing. Now, this is the bit where the complexity gets in of how do you connect those dots and know what these buildings are made of, how old they are, what it costs to replace them, and so on. So when we started building Climate X, knowing that that was the end goal was to get to the financial quantification, we did kick off a big piece of work to do the physical hazard modeling in-house. So we hired all these PhDs, climate scientists, and folks that know and understand that discipline. But at the same time, we started on another project, which was to start mapping out buildings around the world. So we've so far got around 1.5 billion assets around the world, where the building that you're probably sat in right now will know where it is, will know what it's made of, will know how it's being used. And all of this information allows us to then utilize damage curves to connect the hazard to the actual financial loss. And that's critical because that turns it from it's a directional trend level analysis to this is the direct impact that this is going to have to my balance sheet and P&L. And when you can give the customer the data in that format of that number that they can trust, they already know how to consume it and use it because there's other things that are driving shocks to the value of the asset or to that corporate today that's a financial shock. So we need to provide it to them. And it's not just about the actual asset itself in terms of the building. You need to look at disruption as well. So what happens if you've got a commercial site? I probably don't own it because I'm a Tesco or Carrefour or a Best Buy. I don't own all of the assets. I lease a lot of it. So what I'm interested in there is actually what happens if the road and rail and power grid, the infrastructure fails around the asset. How much downtime is that going to create where I can't get goods and services in and out? So we've also done that mapping of 75 million kilometers worth of road, rail, power grid, which allows us to also talk about that level of disruption too. So we give you as a customer the balance sheet and P&L impact from nothing other than an address, right? And so that's really important because that then speaks to the financial impact. So the whole topic moves from climate physical risk to financial risk, right? So we've moved now from talking about climate change, but actually the climate indicators are the things that induce the financial shock. That's the conduit. I don't need you, Mr. Customer or Mrs. Customer, to worry about that. That's my problem. You need to look at this dollar impact, and that's what we give to them. So the customers on our side, 94% of our customers are fully implementing us directly into the transaction layer, which means into the business side. They do not use us for regulatory reasons. That's not the reason why people buy from us, is because they can then use that information to translate an ROI and a genuine business value. So we don't need to obsess over the physical risk stuff. They don't know that better than us, and they know that information is true. And so they rely on us for that. We solve the bit that they care about, which is the actual dollar impact. And that's what they can consume.
Yeah, that's a different perception, which is certainly very favorable for a business, for you, to be perceived as a profit center, more or less, than a cost center.
And we are. There are ways, honestly, that because we operate in the way that we do and we build the workflow that we have for our customers, what it basically means is that genuinely customers already are realizing $1 ROI, where they can be more competitive on deals using what we provide to them. They can close deals not only faster, but they can transact on deals where with other vendors, if they just stop at the physical risk piece, they wouldn't proceed to transact and they'd miss out on these opportunities. So our customers are actually already benefiting from being able to transform the entire client engagement and also the actual process of transacting, because they can do that with us in ways that they just haven't been able to do before.
Impressive. I saw your solution during the demo and I was quite amazed. I would be interested that you explain to us how you built it and how did you collect all that data, because it's absolutely granular. You have a lot of data. And second question, how can you manage from a pure calculation power perspective to have that machine running on a continuous basis and updating daily your clients?
Yeah, so that's been a huge effort, a collective effort over the last 3 years. It's the reason why, we've been through a few funding rounds. So, you'll see that we raised a bit of money, but it was really to build the core of the business, right? So if you think about all of this, what I've just described to you, we provide value, provide physical risk, etc. Like all of this stuff is great. But in the end, we always recognize that we are a data distribution business, right? That's really what we are. We need to know how to build and scale a platform that allows us to efficiently scale and distribute data to our customers. That's basically what we are in a nutshell. Now, as part of that journey, what we did was we said, first and foremost, whatever we utilize needs to be scalable in terms of its nature. So inherently, we want global data sets because we want to be a 6-continent solution provider. So what are the answers to those questions? So we leverage a lot of upstream data sources, and that comes from, I think, over 500 data sources we have, but generally they compartmentalize into remote sensing, so satellite, imagery data, LiDAR, which is like infrared type signals and so on. So we leverage these types of data sources as one layer. We do also look at, and we have standardized more fragmented data sources and unstructured data sets to understand things that are happening underneath the ground. So you can't get everything from a satellite. So there's other ways that we can get that data and use it. But the data only takes you so far in terms of what's out there. We've ran our own models that enable the actual platform itself to quantify and calculate and fill in missing gaps. For example, building ages around the world. It's very difficult to get property age data, but we've built models that assemble and look at different vectors to assume what this building's likely age is, and that model works really well. So we've implemented that. So we've been running all of this in the background to create these data sets. We host everything on the cloud, and we've been working very closely, actually. It's quite public, so AWS. They've been really pushing us to the front of their social media recently because they've been working closely to optimize the way that we actually handle and utilize data. So even when you think about load onto the platform, as more people use what we have, there's elasticity built in so that it knows to pull on more resources so that it can operate with less latency. So there's these types of things that we put in place that help us quite a lot. We also make sure that we only generate things as they need to be. So imagine like a video game, oftentimes you walk through and then it generates the world around you within that radius as it's needed. And so we've got similar types of things happening on Spectra, for example, a platform where as you zoom and as you move around the map, then the heat map starts to load dynamically for what's invisible as opposed to everything loading all at once and creating a lot of burden on the actual tech platform itself. So all of these things are helping us massively to optimize. We also make sure that what we provide is relevant to our customers. So we don't want to overwhelm them. So in our backend, we do have 500 trillion, I should say, data points. So it's a huge amount of data that we have. I cannot give my customers 500 trillion data points. They won't know what to do with it. Because I came from the world of banking and I would have been the consumer of this type of data and also working closely with our customers, what we did was we narrowed down to what do you actually care about? What's actually valuable to you of that? And so that gets to the customer as opposed to the whole lot of data. And the final point is that we generate some of these reports on demand as well. So we worked very closely with our customers to understand how this fits within the workflow. And so we put to the front of the stage the things that they want to see because it's genuinely valuable to them, as opposed to creating a fighter jet cockpit that's really complicated. Yeah. So we've taken really smart decisions from day one about scalability, the data set, speed, security, and stability. So those are 4 S's within the tech stack that we leverage. And we've got a great tech leader. So Andrew Elam joined us from Monzo, where he was the chief of staff to the CTO. So he's used to working in places where there's high regulatory burdens and standards for tech, but then also high volumes of data that we'll be processing. So it's been a huge effort. We continue to optimize, and I'm really proud of the efforts that the product tech science team have been putting in to make sure that R&D is really paying off now for our customers.
You can be proud. So you have different categories of clients. Can we navigate through them? Can you just give us a bit of flavor of what Spectra looks like?
Yeah, absolutely. So I think the simple way to put it in terms from a product point of view versus a client point of view. So on the client side, we are really focused on the place that we know the best because we came from that world. And we think that the impact is going to scale quickly at a global level, which is through the financial services markets. Like that's where the action happens, right? They can leave a change. That's the power of FS. And so banking is a place where we are very much focused. Asset managers, so we have customers on our book that are GSIB, so these globally systemic important banks. Our customers, we've got major global asset owners and real estate investors and consulting groups. So these are the types of people that we work with that are generally involved on the financial services market. And that's because they're constantly assessing new opportunities to lend, to transact. They're exposed to high value and volume real estate or corporates. So that's my bucket. Now, in terms of the actual product, does that mean that I've got 20 different products for each different type of customer? Not really. And the reason why is because the use cases are basically similar across these spectrums. One is that I'm looking to assess a new transaction or originate a new deal. So that's bucket number one. And bucket number two is I've already got something and I want to assess it or a portfolio, right? So if I own a lot of property or I've got a mortgage portfolio or a corporate book, I want to assess it. So it's back book versus front book. And the way that we designed Spectra was two things were in mind. One was that we didn't want to go into consulting because we genuinely believe that we can make this consumable in such a way that you don't need to bring in an army of consultants to help you. Mm-hmm. We know that. And so that's what we delivered. And we were incredibly proud that to date, we've never taken any revenue on consulting, and neither do we plan to. So our customers save immediately hundreds of thousands of dollars if they can go with us versus alternative options. The second point is, in order to avoid the consulting, you need the consumer or the user experience to be great on the platform. So we looked at this and said, how do we simplify this as much as possible in terms of what you as a customer need? So Spectra today, our pitch and our training is simple. If you, Selen, or if your listeners know how to use Google Maps, they are already trained to use Climate X and to use Spectra. Like it's that simple. I can hand you the laptop, a username, password, you log in, and it's easy. And because we've done all the hard work on our side to map out all of the buildings data, to map out all of these damage curves, to map out the road rails, etc., it means our customers don't need to worry about providing that information before they can get going, right? So all the hard work's done. All you need to do is type an address, you get the result, or you drag and drop 100,000 properties in a CSV, and then it just guides you through the process to generate those reports that you want. Mm-mm. So it's super simple. I think within 5 minutes, most people are up and running with the platform and they feel at home.
Didn't you think of building an insurance product?
Insurance is an interesting market. We haven't specifically gone after insurance for a couple of reasons. The main one is when you think about insurance, and majority of the revenues come from P&C, so property and casualty insurance. These are typically 12-month policies that are underwritten by the insurers, right? And so what they've been using until now has been these catastrophe models, which are great at taking what happened in the past and doing a near-term projection for the future. So they're good for the next 12 months, generally speaking. What's happened, unfortunately, is in places like the US is a great example, states like California and Florida, is these models are now struggling and the gap between the insured and uninsured is growing. And because these models are failing, the insurers are literally withdrawing from those markets, or they're repricing at the 12-month anniversary to such a degree that the property is basically uninsurable. Like nobody's going to cover that fee. Now, what I think a lot of the insurers that we initially spoke to believed was that, while it's a 12-month policy, I will just reprice at the end of the year, and then whatever, I just price in the new future and I'm good. I don't need to worry about the next 5, 10, 15, 20 years. The reality now is that system's not succeeding. It's not working for them. The further you move from it, the less relevant it becomes. And you can't turn a cat model into a physical risk model in the sense of what we have. It's a completely different discipline and a different structure that you use to create those projections in the first place. And so increasingly, we're seeing insurers are coming to us because they need to see a different perspective of risk. versus what they've used in the past, modeled in a different way. So we are seeing a lot of inbound from some of the major insurers in the world for that reason. But there's a second part, which is asset managers and banks are using us on the transaction side, which informs today's price of the asset. So the net present value of a property is being informed by data like ours. So even the valuation models that the insurers have versus the rest of the market now, you're starting to go off kilter.
Mm-hmm.
The third point is you can only withdraw from markets as a response so many times because in the end, you will have no business left. And so I think all of these three things are coming together to say the market is starting to move. So we are working with insurers. It's not to say that we don't work with them. There's a lot of, I think, 4 or 5 of the largest insurers in the world are already people that we're in conversation with now. We're trying to really deeply understand what is it that they specifically want, what is the pain point that we're solving for them, what are the real human level problems that they're having, and how do we help them enhance that, but whilst keeping true to our business, right? We're already busy with the banks and asset managers, so we don't need another category, but at the same time, we don't shy away from adding value to them if our services can do that.
Interesting. Thank you for clarifying. Can you say a few words about the ECB study that has heightened concern for banks' climate risk exposure? I think we have a lot of bankers and also asset managers listening to us, so that would be worth digging into this.
Yeah, so there's been a lot of statements over the years around the ECB and expectations on climate risk as a whole. And generally, thematically structured into the transition risk side, which is what are you doing to help us move to a more sustainable future? And how are you funding projects or clients and so on? So around the transition planning. That's been a huge focus and still remains so, to be honest. Like, that's a big part of the problem. When we talk about climate risk, that's important as a vector too. The other side is the physical risk piece, which is what we do. Most banks saw and assumed that the transition risk is the bit that's the today problem, and physical risk, because people think of climate change as decades into the future, they assume that it doesn't affect them today, which isn't true. Like, we're seeing that that's not the reality of the world as we already experience it. Now, where the challenges have come in, I think, with the ECB, and they've done some great work, first and foremost, credit where credit's due, is all the central banks, including the ECBs globally, have been taking a proactive stance on this, recognizing that there's a problem in the horizon that the financial system has a role to play in, right? In the past, if you think about like 08, 09, when we had the global financial crisis, everything that happened since then was in response to the failings of the banking system, right? And so here they've gone and flipped it on its head. And that's also created a bit of a challenge, which is they don't know all of the answers in terms of, nobody knows what the future is going to be. That's where you have multiple potential outcomes. So there's all these different scenarios that we could anchor to, but which one's the right one? Who knows? The second point is, okay, well, I know there's a problem. I can either do nothing and wait for the technology to eventually get there, eventually wait for the banks to catch up and hire the right people, hire the right teams, work this stuff out. Or because we have a literal ticking clock, we got to get moving. And so what happened with not just the ECB, but all of the central banks, they let the horses out of the stable. So they let them bolt and they're starting running now. And their jockeys are left behind. They're not riding the horse now, they're left behind. And then you hang on, what are they doing? And so they've set these initial exercises, so these stress test type exercises, so that they can ask the banks to basically do the homework of, tell me how climate change is going to affect you, right? And transition and physical risk. Here's some scenarios or some assumptions at high level, use them and come back to me. The problem's been that there's so much inconsistency between one bank to the next in terms of how they operate and how they're addressing that statement, how they assume and interpret the exam question, and then what the outputs are that they provide. And usually they don't understand the science side of it well enough to then build really good models or ways to interpret that data into the P&L impact. And so this is where there's a lot of problems immediately that start happening, is the inconsistencies across the industry. So the ECB, along with other central banks, are trying to get some standards or definitions into place. And what we need to get to is, what does good look like? What's good enough? And what's unacceptable? Like, those 3 buckets need to be formed. The second piece is around data gaps and data challenges, which remains. And this is one of the pieces where we really solve a lot of the problems. For most banks, as I mentioned before, they've never experienced this topic before. It's a risk manager that did other risk type of stuff, for the last decade. And suddenly climate change is the problem. and it's a new discipline, and you can't treat it in the same way. It's on different time horizons. So what do you do? And so this has been a major gap, has been around the data and the data quality that they expected to leverage and somehow connect to a probability of default and a loss given default metric, so a PD analytic impact. And that is really, really difficult to do. And so the ECB really has been getting some good guidelines of ways that people can think about that problem statement. But in the end, they rely almost always on vendors, right? They need some provide some parts of those equations. And there's typically been a patchwork of different vendors that creates inconsistencies anyway in its own problems to try and get to something that looks okay and presentable. But they're good to do it for the box checking with the regulatory exercise, but they're not willing to move to the next step, which is I'm going to plug this directly into my originations. It's going to affect pricing. It's going to affect capital. It's going to affect impairment models. They're not willing to take that step because that's way more complicated and dangerous. That's going to affect them directly. So the ECB, recognizing there's not been enough progress fast enough, there's not enough ambition, or there's not enough, work that's happening with the projects to try and address these problems. They're not moving at the pace they wanted. They issued letters to, I think, 20 of the banks saying that this is unacceptable. If you fail to move at the right level and speed and demonstrate progress, then there's an implication and the stick is likely to be fines, or there's additional capital allocation that you're going to have to hold. So there is already consequences now, some stick being shown by the ECB to say you need to do better. But I do empathize with the banks because the banks are saying, but what exactly are you asking me to do when I don't think there's a way to solve this problem? So what is the solution? And none of us can find it, by the way. And it gets even more complicated for different reasons on the corporate side, because on the corporate side, you don't even know where the assets are of the companies that you're expected to assess. And so suddenly risk are asking the front line to ask the customer to complete these ESG surveys. And then they do all this desktop research and they try and get some sort of sense of what the risk might be of a corporate. And they need to try and quantify that. And it's a complete mess. So we solve those problems too for our customers, which is unique to us, but we can do all of that work for them. And we can do it through an automated process, which means that they can get through those requirements faster than anyone else in the market using our solution, but in a very robust and defensible way. So I think it's good news what the ECB is doing in practice and philosophy. I think people generally support it. The time is the concern, but the time is a concern because people don't know what the solutions are to the problems and they can't see the pathway to getting that problem solved with the existing vendor landscape. And hopefully what I'm hoping is that because we came from this world, our empathy with the customer is unparalleled because I spent a decade doing that work and specializing in it. It's a very specific task. And so we built a whole workflow solution that says, we don't just solve your pipe that's leaking in this little bit over here on physical risk. I'm going to solve all of the problems. In fact, I'm going to rip out the whole leaking pipe and swap it with something that's going to give you higher throughput, higher confidence, and more defensibility. So there's work to do. I'm really curious to see how much of what the ECB says is going to be, veiled threats versus are they really going to take the next step and say, hey, whatever bank XYZ, you got a problem, we're going to give you a fine, even though we don't really know what you can do better. I don't know if they're going to take that step, but it'll be fascinating to see what happens.
Okay, there was something I was intrigued about is the issue with governance in banks. And on my French channel, I released an episode with one independent director of Amundi Asset Management, which you know well, because I wanted to point the fact that within the risk committees, you hardly find people with a huge knowledge of data and climate-related issues. And this is why I had a discussion with this incredible woman, Natalie Wright. Do you think that there is a direct link between governance issues and climate risk, proper climate risk coverage? That's my assumption.
There is very much so. And it's an interesting one because when we started the company, it's part of the reason why we've done what we have. Like we could have technically bought data sets from different places and assembled that, and then we could have tried to build like a financial layer on top of it and said this is what we do as a value and just deliver that right into the market. The problem is that you lose control. Like one of the key things that to the frustration of many people in banking, like we try and avoid model governance, like we're allergic to it, right? So I will call this, no, it's not a model, it's a tool. It's a tool, call it a tool because it's in Excel. And so then that avoids the whole governance traps that you need to do. So we know that it's difficult and it's painful, but actually it's a really good discipline to have. And so we implemented from day one model risk management standards that the PRA has for its banks and its supervised entities into our company. And that's a huge burden that we've taken on board, and it changes the way that we operate as a business, because it means fundamentally, one, we need to have complete control of our data lineage, and I need to understand what's going on each step of the way. So that was already like there's more time that we're trading in terms of speed to just deliver, because we want to document things and make sure that it's properly captured. The second thing is that we have a full database and inventory of all of our models that we're leveraging, so that we understand how those models have been built, what are the limitations of those models, what assumptions have we wrapped around some of those limitations, what are the data sources, what are the problems with those, so we've got like a really good model inventory that tells us a lot about each of those models and how they're being leveraged and how we've created them. And then what are the types of outputs they're providing and how do we have any form of confidence in the output? So that's where you start to get into the validation piece, right? And start to quantify some of those results from the testing that we've done. And so the way that I try and simplify this for people is, ultimately what we say to our customers, and I think they really appreciate this, because I used to literally write this stuff up, right? And we'd sit there in the model calibration meetings with the approvals teams and fight with, somebody over there in the audit. And we used to do that work, but in the end, it ended up in a particular format that the banks are used to. And so we say to our customers that we will give you that book, that piece of paper with those headings that you're used to seeing, and we're going to hand it all over to you at the right level of detail, because you don't want a 10,000 page dossier that's got everything in it. You need it communicated in the right way. And so that all exists within ClimateX. So we say to our customers, look, because we own everything that we do, we can tell you, number one, here's the ingredients list. So all of the items, all the data sources that we have, we're fully transparent about that. And here's the recipe card. So this is the methodology. This is what we've done. This is why we made those decisions. These are alternative things we could have done, but we chose not to. So we open all of that up as well. And then we say here at the end, there's your cake, right? And hopefully, if you like the ingredients and you're not allergic to something over here, and if you like the methodology and the way we've cooked it, it's cooked just right to the way that you like it, then you like the cake at the end, right? So that's what we give you. And we'll never, ever say to anyone, our cake is better than someone else's. What we do say to them is, please go and, before you eat that food, you probably want to know where it came from, right? And if you don't know that, well, ask the customer, ask your other vendors, like, do you have the answers to those questions? But from a governance point of view, why it ultimately matters is that this is linking into the business side, the transaction layer, where you, Selene, if you're buying a house, your interest rate will be affected by this data. So you should make sure that your bank is being responsible in terms of what they're putting into that model, into the card, what's going into pricing that then affects you. If you're a shareholder, you care about your dividends. So, well, actually, that's constrained by all of these other things. So, is the bank doing its job in properly onboarding something that they can trust and understand? And we always say to our customers and to everybody in the market, we can never, ever claim, in fact, nobody can claim to have the best models. The best model is the one that said in 2054 that there would or wouldn't be flooding in this area, and they were right. But we won't be around at that time to answer those questions, right? So we can't say that we are the best. That's the most accurate. It comes to somebody about something that happens or may not happen in the future. What we're interested in saying that this is what we did. These are decisions we took. This is why we took those decisions, and that's the output leads to. We think that story that supports the end number makes sense. And we can stand based on these assumptions. If you're good with that, then let's proceed. Most of our customers, I think the thing that comes up more than anything, in fact, more than the platform and how great it is, the workflow integrations, what they care about is they can trust our process, they can trust the methods that we've been through and why we've taken those decisions, and therefore they can trust the output of all of that, which is the number that we deliver to them.
I like your vision. So you mentioned you had recently a funding round. So where does this funding round bring you?
Yeah, so this funding round we've just closed, and I think it leaked on sifted anyway a couple of weeks ago. So thank you to whoever it was that was so excited.
That was not official on Sifted?
No, I think the market has a leak and we didn't have any comments. So this is the first comment that's happening around the fact that it even took place. But yeah, so this funding round is really important to us because, we are at a point now where in VC speak, I guess, like we've achieved what we believe to be really strong product market fit, as in we are solving genuine, real problems for our customers. We can solve that for many customers, global customers. And so increasingly now we see that this is really about how do we get what we've built and spent so much time working on in front of them, right? And so that's building the actual front end of the organization to sell our products, yes, but also to support the customers as they go on this journey and then feed their needs and their future requirements back into our product roadmap and development. So that's been a critical part of what this funding round is going to enable us, is to really elevate to that global scale now. It's a real landing mark for us. In addition to that, we also are going to start our international expansion as well. So we do have customers that have the HQs in the US and in Canada. And so there'll be a lot more activity happening on the US side, particularly given that the market is already waking up to this. Now, by the way, I should say, when I say waking up to this, you're probably thinking physical risk because of the SEC disclosures and, they care about physical climate risk. What I'm actually talking about is, from a Climate X perspective, is they can make money in ways that they never made money before. They can save money in ways they never saved before. So whenever I go to a customer and I say, hey, are you ready for physical risk? We can have a debate and discussion about it. And we can conclude that, yes, we think the answer is yes. But if you say to our customers, are you ready to save money? Are you ready to make money? Are you ready to take a competitive advantage? The answer is, I was ready to do that last year. Where do I sign? How do I get moving forward with this thing, right? So it's a very different conversation. So that's where the funding round is going to take us as part of the Series A. It's also going to allow us to develop some additional products that have been on our roadmap for quite some time, to expand the offering beyond just the physical risk and assets, but we are leaning into additional areas of interest. So nature biodiversity keeps coming up as a topic that people are exploring. We're part of TNFD, and so we know that there's another type of adjacent problem that we can help our customers with as they go on the journey and that discovery process. So we want to walk alongside them with that. So I'm excited to see how the product evolves over the next 12, 24 months.
Me too. Me too. Lukky, I always, as you know, conclude my interviews by a book recommendation. So what is your recommendation to us?
So my recommendation is a boring one because my life is just really geared around, and this is for anybody here that wants to start their own company or is starting their own business, but there's a book called Zero to IPO that I love. And the reason why I love it is because, it's really explaining what the mechanics are and what the real grind and the difficult parts of building a global SaaS business. So it's actually by the founders of Okta. So a lot of, I guess, the enterprises here will know what Okta is because you use it for single sign-on and that kind of thing. But that approach of just centralizing everything around the customer, obsessing over being there for the customer, and turning up in person, people buy from people, and the importance of trust and how we sort of leverage that as part of building a new category is really, really draws a lot of parallels to what I'm doing right now at Climate X. So it's just fascinating to see somebody else did it on a different type of journey. And this was specifically around the single sign-on, that revolution that happened around technology and security, but in another space that we're walking in. And then from time to time, they bring in other great founders of great companies that talk about those specific difficult challenges that they went through. So if anyone's interested in enterprise sales, which sounds boring, but for me, it's super exciting, then I'd definitely recommend that as a good read.
Thank you very much, Lukky. That was great, and congrats.
Awesome. Thank you.
Bye. Thank you all for listening and sharing this moment with us. Don't hesitate to contact me on Twitter or LinkedIn to share your comments and reactions. You can also rate this episode on your favorite podcast platform. See you soon.